Welcome to episode 3, Managing Your Debt and Your Credit Rating. Debt is not a 4-letter word, but it is probably the most challenging aspect of our finances. It is probably the aspect that keeps many of us awake at night, not knowing how we are going to pay off the mountain of money that we were willing to take in order to obtain that which we wanted immediately. The best way to deal with your debt is to learn the concept or learn the principle of delaying gratification. Asking yourself, do I really need it? Is this something that I must truly get, or can I wait until I can actually afford it? Easy to say, not as easy to implement. Because for many of us, when we start out either at work or just in life as an adult, we often have far more expenses than we can actually carry on the salary that we receive. And so what do? We contact a cash loan, we take out a personal loan, we put ourselves into consumer debt, which can be very, very challenging to pay off, and on top of that, extremely costly. We're not going to enter into a debate into whether, debt is good or bad. I think we all know that debt is necessary. What we will look at is, under what circumstances should we take debt? Do we take debt for anything? Or do we consider the really big and expensive items that we actually cannot afford to get on our own salaries? And that would be my premise, that we consider debt for those big, essential items and not for the everyday things. Debt is easy to take, you will find, much harder to pay off. And obviously, when you take on debt, you need to be clear that it's something that's going to have to be repaid. So you're taking on a responsibility and a commitment, which doesn't always feel good. Sometimes it may be better to actually purchase that item in cash. On top of it, depending on the type of debt you're taking, you might find that over time, you're paying as much as double the capital amount. So when we take on debt, we are basically willing to give up the use of our money in favor of something else, right? And usually that item we receive immediately, but we keep a commitment over a reasonable amount of time to actually pay it off. And why it can end up being almost double the cost is because of a concept that we call compound interest. I'm sure you've heard of the concept before, and it really is interest upon interest. We've often looked at it in terms of how we can earn more savings or more interest on what we are saving. But it's just as important when it comes to debt. Let's imagine that you take out a home loan for 1 million Namibian dollars over a period of 25 years at a constant interest rate of about 10%. At the end of your 25 years, you would have paid a total amount of 2.7 million Namibian dollars approximately. With a principal loan amount of 1 million, that indicates that your interest is about 1.7 million Namibian dollars. So in the end, for a principal amount of 1 million, you are paying a lot more than double, in fact. So what's the relevance of your credit rating then? Your credit rating is really a measure or an assessment of your own affordability and what you come across as for a credit rating agency. We are looking at the assessment of the risk that you pose to the financial institution in terms of what is your ability to pay back a loan that they may offer you. And how do we look at your credit rating? We basically have a look at what your general habits relative to money are. Credit rating agency would review your consumption habits, things like how you pay your bills. Are you regular? Do you pay them on time? Or do you skip payments? Do you sometimes pay less than you owe? When you have a bad credit rating, what you might find is that you are unable to obtain credit from a reputable financial institution. So what's a good measure to keep your credit rating in check and to keep your debt manageable? Credit utilization, which is basically how much is it that you owe overall. Then they also look at what is your payment history. Are you someone who pays on time and regularly? Thirdly, what type of credit do you have? What are the kind of things that you take out debt for? And then they look at your credit history. So how long have you been paying off debt? Some institutions might actually be willing to look at how long and how well do you save, because many of us might not have a debt history to show. And finally, they would look at new credit. In other words, they're looking at what kind of inquiries are you making relative to debt, because that can point you in the wrong direction if you are taking on a bit too much debt. Now let's have a look at some ways in which we can keep our debt manageable and affordable. Few key things to remember. The first and probably most important, purchase what you can afford. That means ask yourself if you really need it. Look at your current habits. Could it be that you are living beyond your means? A general rule of thumb would probably be to not extend yourself to more than 30% of your disposable income on debt. The second thing, put yourself on a cash diet. When you actually work with money, you have that feeling of it going out, and it helps to create an awareness so that you don't spend beyond your means. Thirdly, don't miss a payment, because that would reflect in terms of your credit rating, and it can really influence the ability to take on even more debt. Yes, sometimes we are unable to make a full payment, and in that case, even if you just make a payment towards your debt, that's a good start. Then pay off your debt quickly. Now, when it comes to paying off debt, we have two methods that we speak about. The avalanche method is a method that looks at all of your debt and then prioritizes the one that has the highest interest rate. The feeling there is that the higher the interest rate, the more money I'm giving up on. So let me pay that off as fast as possible. It's a good method. It probably will help you to pay off your debt faster. However, I am more in favor of the snowball method. The snowball method doesn't look at your highest interest rate. What it looks at is your smallest outstanding debt. If you are then able to make an additional payment to that smallest outstanding debt, the chances of you paying it off are quite good. And what you would have at the end of that moment where you look at that outstanding balance that is completely gone is, from a psychological perspective, you feel as if you have achieved something, and it gives you that impetus to get ready for the next debt. You would then take that amount that is now free because the outstanding debt is paid and apply it to the next debt that was just a little above the previous one. So you're starting from the smallest amount and working through until you get to the highest amount. It's a method that takes longer, but from a psychological perspective, which is extremely important when it comes to your money management, it has you feel a lot better. Tip number 5, shop around for the best rate you can get. You don't have to take the interest rate that the first financial institution that you go to offers you. You can shop around and get a rate that works for you. Communicate with your creditors. Now, many of us might find that we have a tough month, and in that tough month, we might take that ostrich mentality of just sitting in a corner, when you don't answer the private number calls that are coming through, although you know that you owe that person something. It's probably better to communicate with that creditor. Give them a sense of what it is that you can afford, because as long as you pay something towards your debt, it shows your commitment, it shows your good faith, and that can act in your favor. Next, commit to not taking on any more debt. This is especially important when you find that you have bitten off more than you can chew. It's important for you to take the time to plan ahead, not only to get out of debt, but to ensure that you don't find yourself in that position again. Maybe it could be worth your time to share a problem with your friend, and perhaps to find an accountability partner, someone who can hold you to account and who can remind you about what you said you want for yourself, keep you in check, and ensure that you don't overspend. And then finally, we say, have a plan. Now that you have a clear view of your debt, you might see that there are ways that you need to adjust your budget in order to make sure that you can take care of those areas that are giving you so much pain a lot faster. For others, another option might be to consolidate your existing debt. So what does it mean to consolidate your debt? In many cases, you have a number of different debts that you are paying to different financial institutions and at different interest rates. When you consolidate your debt, what basically happens is you get one large amount that is used to pay off all those existing debts, and then you only have one creditor left to pay. It can be beneficial in the sense that you would probably pay a lower interest rate and you only have to focus on this one entity that you are paying. Nevertheless, we caution you, it's important to be responsible around consolidating your debt, because the result of the lower interest rate is actually that you extend the period of paying back your debt much more. So you're paying less in terms of your interest rate is lower, but you're going to pay that debt for longer. There is a way to deal with that, and that is simply to try as far as possible to stick to the higher amount that you were paying when you had all of those willy-nilly debts all over the place, because that then ensures that even though you have a lower interest rate, you pay off the loan in the same amount of time because you're paying off more than you owe, which allows you to pay off more interest upfront.